Good evening, ladies and gentlemen. I wanted to do a dedicated stream, primarily just to the TFSA and the RRSP, these kind of beautifully, utilized tools to invest. And I think I'm going to kind of scale this back, give you guys a little bit of a build-up story into this, because there's so many newbie investors out there, which is not a bad thing, but these questions that come up, and I feel like the influencer space kind of really detriments most people's investing strategies. And I'm not trying to offer financial advice, but so many of you say, sorry, I'm new to investing. So you have 4 ETFs, and I was wondering if it would be fine if I just copied the same ETFs and no stocks. Also, is the reason you don't have, or sorry, also, is the reason you don't have XEQT in there because of the overlap? Now, XEQT is probably a single stock ETF you could buy because it overlaps into, global economies. It's kind of those like, what is it, VTI, whatever the global indexes are, which aren't things that I particularly buy, but you could invest in those. But no, don't do what I'm doing here. It's like there's so much things that come into the variable plays of, your time horizon, your risk tolerance, how much income are you making? Do you have a family? Like, there's just so much that comes into play with this. And I also get these funny comments. Forget you. What stocks does your miss think has upside? I want another Facebook like call she made way back when none of us had the cojones to pull the trigger. And she didn't buy the bottoms of the, the interest rate cycle through 2022, but she did buy the bottoms during the 2020 market crash. And bringing this into a well-rounded conversation, as I mentioned, yesterday or the other day when I made a video, I was going to show you guys the kind of totality of the portfolios without directly sharing with you the dollar figures, because we have a lot of overlapping positions, and our combined net worths are somewhere around $1 million as it stands today between our total assets minus our liabilities. But before we kind of dive into this and break it into the TFSA and RRSP side of things, I just want to remind you guys, like, I started investing 10 years ago. I just finished paying off over $20,000 of debt that I took off my mom's line of credit to start a business. And I remember the frustration in the almost 3 years it took me to pay off that debt. And, I looked at my mom and with a very serious conversation, I was like, man, I wish I could just go make money, give it to someone else and own a piece of their business. And that's when she kind of introduced me to the epiphany, the moment that triggered, everything that I have now, which was, she's like, have you ever looked at the stock market? And boom, I was like hooked day one. I remember, before Graham Stephan, all we really had was StockTwits, Stockhouse Forum. We didn't have a lot out there. We had BNN. I remember calling in as like a little gleamed eye investor, talking to Kevin O'Leary on BNN and asking him about Coca-Cola, to eventually realize that the playing field in investing, whether you have $1 billion or whether you have $100, you all have the same problem, which is a beautiful thing, because it kind of removes that veil of the rich, right? Because the rich aren't any smarter than you, and if you can prove you know more than the next guy to you, you could be very valuable in the marketplace. Which is, again, where all this love and fixation came on the market for me, eventually leading to some pretty incredible, profound performance over the last decade. Eventually meeting my fiance, building into our own portfolios, our own personal lives, our own investment styles, our own income styles. There's just so much variable that leads into this, which I think is also very intriguing, that I hope you can learn from, which is the whole point of making these videos, not to copy them, but to learn from them, because I, in my portfolios, primarily only own VDY, SHDVO, soon now like VNQ, but the wife owns a lot of the same ETFs. She owns pretty much all the same ETFs. She owns a lot of individual stocks, which you can see in here, like, as mentioned, Meta being the largest single stock position she currently owns in our kind of combined portfolios here. But, there's a lot at play here, right? So I want you to keep in mind, there's simple ways of investing. If you have a job, you don't want to think about individual stocks. You don't want to care about these recession cycles. You just cost average. That's all we do. We never stop buying, baby. We're always buying something. We just bought stocks last week. I'll be buying stocks next week. It never stops. So I want to just pair this into these accounts and why they're so profound and life-changing, and just kind of how you can adopt them into your own investment styles and kind of the perks and cons to both of them. And I know this is probably going to be a recap for a lot of you. A lot of you just want to see the stocks that we're buying and what we're doing, but I think this is so prevalent to newbie investors, and it always bothers me how underutilized they are by most people, because I didn't realize what a TFSA was until I think 2 or 3 years into my investing career. I mean, there was no one like Graham Stephan or Brandon Beavis to tell me. Like, there were no Canadian influencers at this time 10 years ago talking about these topics. I had to figure this shit out the hard way. So I'd have been much better off if I figured it out sooner. But hey, you got to start somewhere. And I'm glad I started when I was 23 and not now that I'm 30, where I think, even a lot of people are starting, right? So the sooner you get into this, the better. But this is my tax-free savings account as it stands now. I have currently built up about $190,000 of contribution room. I got a little ways to go to get back there. We're almost surpassing that 100K mark again with the stocks that are in here. But like I said, I'm very risk adverse to where I used to be in my investing career. Hell, in my TFSA, I was owning Canopy Growth Corp and some of the most risky investments one could own. Hell, I just traded Tesla in here. Though it was a very, mild amount, in my opinion, for my risk tolerance. But I do take into consideration the absurd amount of risk when you're buying individual positions in an account like this, because this account allows you to make tax-free income in perpetuity for the rest of your life that you can draw against whenever you want without it affecting your tax bracket. So even if you're making $100,000 a year, you could pull anything out of here. All these gains, I could sell some $2,000 S&P 500 gains and use it without it impacting my tax brackets, my income levels, or any of that. So this account is something that a lot of countries do not offer. The US doesn't have luxuries like this. I think Europe might have a similar account, but this is a rarity, right? Like this is something that you have to be an Indian to come close to status like this tax-free income. So this is the government's way of saying, hey, everyone gets a little piece of Indian status or native status to some extent. Don't know how racist that is, but it's that's the reality of it. So this is a beautiful account, but you have to recognize that if you lose value in here, it's gone forever. You can't get value back in this account. So you want to be very cognizant of how you're investing, and how you're taking advantage of the contribution room that you have. And for me personally, at this point, I even feel like I'm taking on quite a bit of risk with some of these stocks, but it is a much more diverse way of investing with VOO. I'm just starting to buy into some V&Q, which is real estate US ETF. You got VDY in here as well, the Canadian stocks. And again, I've only started filling this up over the last 6 to 12 months, because I liquidated it to do a real estate purchase, which again is another beautiful reason to have these accounts, because I can pull out a large sum of money and utilize it for asset purchases or whatever. But in this circumstance here, I am taking on other risk as well, because buying US stocks like VOO and VNQ, I do get a withholding tax. So with dividends, I have to pay the US government 15%. So like VNQ that pays 4% as an example, I'll probably be losing about 0.6% of that dividend. So we'll just say 0.5 to make it easy. I think it's over 4%. I think it's like a 4.5% yield, but just to make the math easy, I think 15% of 4% is 6%, if I'm not incorrect on that math. So that is something you got to take into consideration, but I look at these as having some growth potential behind them. And we'll round back to that conversation of playing currencies and talking about, withholding tax in a moment, because there are some things I want to expand on further. But before I do, I think it is appropriate to kind of bleed into the RRSP side of things. The RRSP, I purely hold SCHD. I did hold a little bit of Tesla in here as well, not that long ago, with a bit of a quick swing trade. But still, I again, just trying to be a little bit more risk adverse. And as somebody that wants to retire early, maybe you do not, I am looking at utilizing these accounts a lot quicker. And the RRSP is a registered retirement savings plan. And unlike the TFSA, this works quite differently. Probably almost similar to maybe, I want to say Roth IRA or 401k, but there's caveats, right? So the idea behind this account is you make money at your job. You've paid tax on that money, more than likely. When you put, basically the government every year allows you, and I can't remember what the exact percentage is. I'll have to look it up. I should have done a little bit more fact checking before I did this video. But every year, whatever you make at your job, the government says, hey, a percentage of what you made off your income this year will allow you to put it into this account called an RRSP. And when you put it in this tax sheltered account, we will refund you any taxes you paid on that money. We are going to defer the taxes. So you get that money tax-free today. The money goes into this account at which it's allowed to perpetuate tax-free gains and income, dividends, capital gains, tax-free until you withdraw it. Once you pull that money back out, it then affects your income tax bracket. And that is when you are going to pay the income taxes that you deferred, that the government allowed you to defer once you put it in this account initially. And you can only have money in this account, I think, until you're up to 65, at which you have to draw it out. Or there's some other thing you can do where it's called a withdrawal plan, where you can start transferring it into some other account or something like that. But for the most part, I want to actually pull the dividends out of this account way before I'm 65, which is why I'm focused on a dividend-oriented ETF. ETF here. And the cool thing about owning SCHD and US stocks, and I don't know how this happened, but the government said, hey, we're going to let you own US stocks without paying withholding tax. So they waive the withholding tax. So if you want to buy US dividend stocks in here, it's probably the most opportune thing you can do. But again, keep in mind, even though you're saving 15% on the withholding, if you ever withdraw this money, you are going to pay your marginal tax bracket rate on it, depending on what your income looks like that year. So it's better to use this account when you're not making as much money or you're going into a retirement phase, because then you can draw it out at your lowest income bracket. So you're looking at these two accounts kind of working in tandem, right? The TFSA, you already pay tax on the money. You can use it as you wish once it's in the account. The RRSP, we're defer the tax into a future date, but you can use it however you want in this perpetuated, tax-free way. These two accounts can completely change one's lives. And I just want to state really quickly, because I hear so many people bitching about like Canadian tax reform. And, I was watching a stream where they were saying the 60% tax rate now on real estate gains is crazy if you're selling condos, and they don't even understand inclusion rates. They don't understand. And they make things far too complicated, but Canada is by far the easiest country on the planet to get rich in. Canada wants you to be rich. They give you so many tax benefits and just ways of waiving tax. We'll talk about corporations toward the end of this stream, but there's so many things you can do if you just talk to an accountant or a corporate accountant to learn how these things operate. But these are things you can take advantage of today that you can open at no cost that will do nothing but save you money and make you rich. Even if you're risk adverse, you can buy your bonds, your GICs. You can buy almost any investment vehicle you really want through these accounts, some of which don't even have to belong on a publicly traded market, to be honest. You should really dive into the utilization of these accounts. Now, I want to answer just a couple of these comments that I think really point out the hilarity of kind of the operation between US stocks and Canadian stocks, because some of you will notice that I actually hold US accounts within the TFSA and my RRSP. When you look at the positions I have in VOO and VNQ or whatever, those are actually US held positions. They are traded in US dollars. They do not convert. I purely am just owning and trading within US dollars. It's like I live in the US tax-free as a Canadian. Think about it. It's like I have US dollars. I make US money off the US economy, and I pay nothing. It's all tax-free for the most part. I also don't forget that the US dividends are paid in US dollars. So if you're holding these in a TFSA, even though you're 15% withholding, you are still making money on the exchange because of how crappy the dollar is right now. And that is another, caveat you can consider, because the Canadian dollar has been, more or less deteriorating over the last 5 years. And I think as we cut interest rates, hopefully our dollar starts to get a little bit stronger on the interest rate cuts. And then, hopefully as the US begins to cut interest rates, their dollar starts to drop. And we'll see a little bit more of an increase in the value of the Canadian dollar. But this is why I like trading in US dollars, because it's a global accepted currency. And in your risk tolerance and your diversity, I think it's prevalent to, diversify currencies and income and where your money's coming from, because most people have a country bias where they just want to invest in the stocks that their country holds, right? Because if you go on like Blossom, for example, which I'm sure many of you have seen, PPCEN, Brandon Beavis, a lot of people have been promoting it. I don't have my account. I have an account on there, but I don't really share my portfolio as much. But I noticed that most people on Blossom, because they're mostly Canadian influencers, really own way too many Canadian stocks. And because they only own the vast majority of Canadian stocks, since 2021, those Canadian stocks have lost almost basically 12% of their value just in the currency conversion on a global scale, right? Or at least against the US dollar. So, I mean, you've lost 12% just holding it. So you have to take that into consideration in your gains, because you're not just playing on an individual country basis, you're playing currencies. It's a global game, right? Which is why I always kind of round back to this first question here as well, that I think is, very important, which is, should I just invest in the 4 ETFs that you own? And no, you probably shouldn't. It's like you can own these global ETFs like that XEQT, and that might be the more prevalent thing for you, because it's going to give you global exposure with one stock. And then you can cost average into it and not worry about the noise, because the noise is what's going to kill you. And I feel like being on Blossom, and I'm not like shitting on Blossom by any metric, I love learning from everybody, but you do have to take into consideration that if you find yourself in a confirmation bias where you're just focused on dividend stocks, or you're just focused on growth stocks, or you're just focused on Canadian stocks, like you're severely going to detriment your portfolio, not only for the longevity, but at scale. Like in your early days, you can focus on a few things. I don't think it's a big deal if you have $5,000 and you put it all on Apple or QQQ. because you've got a long road ahead of you of investing, right? Which kind of leads into this next question. But at scale, like once you get to my level, or you get to your own level of wealth, you aspire to make tens of millions of dollars. Like you're going to recognize that at some form, you're going to want to have longevity in that money. You're going to want to have preservation, perhaps over necessarily growth. It's kind of like the Warren Buffett style of investing, right? Which is kind of why someone asked me here, can you make an upload about growth ETFs and how important they are to the younger generation to be buying rather than individual stocks. And I even think this is an incredible point that he made here, because I play individual stocks as somebody that has focused on the market for the last decade. I was in the entertainment industry. I worked weekends, 5 days a week, man. I was glued to the stock market. I keep forgetting that I had that upper advantage over a lot of people investing, because if something changes, I can change with the market, as I can still do today, because most of my job is highly market involved. It's actually all market involved at this point. I'm not even really in the entertainment industry like I used to be. I'm just like stock market 24/7, 7 days a week, small caps, large caps, mid caps. I talk to everybody. I invest in everything. We talk about it all. So I think today, even as Tesla as an example, I was able to trade Tesla relatively quick because I'm paying attention to it. Most people probably don't have that opportunity, right? So you have to recognize that that is a lot of risk. And a lot of people bought the tops of 2021, not realizing how quick things will turn. And then they get stuck in that psychological debate about, it's down 40, 50%. Do I take the loss? Do I hold? Do I cost average down? And that becomes, a detriment to yourself, because you didn't go into it with a plan. You don't have stop losses. You're not paying attention to balance sheets, market shifts. You probably don't understand the industry you're investing in. And I'm trying to overload you with information so you understand the absurdity of risk. If you don't know, you don't know. And people just don't know everything about a company. I can't sit here and explain to you how Apple works at the scale it works. I've never been to their factories in China. I don't know how robotics can play into building a smartphone. I don't know any of that. And that is all market risk, right? That's probably why, to some extent, Warren Buffett is selling 50% of his Apple position. He doesn't know, they're basically a duopoly. Like they're a monopolistic company, which is why Google just got, kind of screwed with the government stepping in. And we don't know what those fines look like. Do they bar Google from paying Apple? What is it, like 20 billion a year or whatever it is? Like a stupid amount of money. Like we don't know the risks that are going to come into play with any of this. Like there's just so much. So this is why I think ETFs are so prevalent for most people, because you can just buy the Qs and you can cost average, and it doesn't matter. Say Apple or Google get hit with a fine and the stocks tank miserably and they bring the Qs down with it. Well, guess what? They're still great businesses. It's going to offer more certainty into their future. And now you get an opportunity to cost average into them through an ETF. Or again, the S&P 500, right? If they become too detrimented, their market cap deteriorates too much, it automatically will equal weight it away. Like it just weights it based on market cap. So this is why ETFs are better mechanisms for investing for the vast majority. 98% of people should just be buying ETFs, and they should cost average in perpetuity until they're retired. It's a very easy thing to do, but most people will never do it. And I don't think I have to recommend too many ETFs. I'm sure you can see all the growth ETFs, the SMCH or whatever your that's probably not the right ticker for it, but you got your semiconductor ETFs, you got your Qs, you've got your triple leverage Q. There's so much things you can invest into, but it's a matter of what your risk tolerance is and your ability to stomach volatility. Because some people are just happy investing in cash. Like a lot of people right now are just happy still making 4 or 5% off high interest savings. That could be you. Could you create a video discussing corporate investment accounts? Not many people cover the topic, so it would be helpful. I am still going to do a dedicated video to this at some point. The video usually doesn't perform well. I'm trying to figure out how I can get it to search rank on YouTube and solve people's problems, because I think the next level up, if you are as maniacally insane about the market as I am, I think the next level up, if you want to build an absurd amount of wealth and you want to take advantage of crazy tax benefits, you have to figure out how to start a corporation, or for the most part, just be a sole proprietor or whatever, because that allows you to really, really change your outlook of spending, especially if you own real estate, because the way corporation works is they spend money first and then pay tax on whatever's left after. Whereas if you are working a salaried or an hourly position, you get taxed up front on the income, and then you got to go buy stuff that you're paying tax on. So now you're paying HST and tax on another product you're buying. And that's where you hear about people saying, oh, I'm losing 50% of my income to tax. Well, it's not just that you're paying probably 20 or 30% to the government, but you're paying like another, 13% HST on any product you're buying plus GST, right? So you're losing a lot on both ends of the purchase and making the money in the first place. But a corporation doesn't operate like that. Corporation operates as you make the money pretty much tax-free until you keep it at the end of the year. And then at the end of the year, you're only taxed 13%, less than 13% on the first $500,000 made. So you can make $500,000 in the tax bracket that's only like somewhere between 10 and 13%. Which is mind-boggling. And that's just the first, like barely the tip of the iceberg. And then you talk about that money that you retained, that you paid a lower income tax on, that you can now invest in your corporation. And oh my God, that's where things start to get a little bit crazy. And it's like a whole new realm of, and I've got about 120,000, I think, in my corporate account between some of the small cap investments, and most of it's in the S&P 500. I think I have like over 100,000 just in the S&P. So yeah, it's a fascinating endeavor, and it took me years to figure a lot of it out. It's not fun by any metric. I don't think it's fun, but it is a good security risk because if you get sued, they can't take what's in your corporation because it basically is a separate identity to the government. But again, it also comes with caveats because you can't use that money as a down payment on a piece of real estate for your personal residence. Which is a problem that I ran into. It's very hard to get a personal loan if you're operating purely through a business trying to rip the government off saying, hey, I'm going to run my business and leave all the money I possibly can in the corporation and pay myself hardly nothing. So I'm in the smallest income bracket. But then you try and get a loan from a bank for a personal loan and they're like, go fuck yourself. You don't make any money and your corporation isn't you. So if you want to buy the house in your corporation, you can, but that means your corporation owns it, not you. And that means you don't get the first time home buyer benefit or any of the other benefits that we were going to give you. You can't use your FHSA toward that, and all these other benefited accounts that I haven't talked about yet. What are your thoughts on a move that TRP Energy is making, good or bad? I'll take a look here in a sec, but let's read through some of the comments and I'll round back to that. Yeah, man, this is such a loaded conversation. You almost got to make a course on it. But again, I don't think I'm a genius. I think you just really need to sit down with the right corporate account and they'll help you out a little bit. But we'll start from the top. Can't wait to max out my TFSA for life, 100%. Scotia has the worst trading platform. Really, I love Scotiabank, man. I think Scotiabank and TD have the by far best platforms. They're so ease of use. They do projections on your dividend income. I honestly think Royal Bank has the worst. We use 4 banks, right? Like we use TD, Royal Bank, Bank of Nova Scotia, Canadian Imperial. I do not use Wealthsimple because they still screw you over on US stocks until you own like a stupid amount. Like I think you have to have like a couple 100,000 with them before they even start giving you any benefits on like foreign exchange. Whereas like Royal Bank, for example, even though I'm paying a $10 commission on every trade, Royal Bank, they give me, they, as a client, they let me currency conversion for free, or that's at least what they tell me. And I've done the math and it doesn't seem too off from Google, but they're not really charging me to do a currency conversion. So I can transfer my money over to USD and not like, whereas PayPal, which is why I hate PayPal, charges like 3 to 4% or something fucking stupid. I hate when they charge me foreign exchange fees because it's like one of the biggest things I do. Is exchange money. You timed Tesla perfectly to sell. I did, but then again, you give it 10 years or you give it another 5 years. And if I don't buy back into it, one of two things happen. Either it keeps going down and I look like a genius, or eventually it recovers and I never bought back into it. And it goes way beyond where I sold it. And then I look like an idiot because I should have just bought it back. If Tesla drops enough, I might still buy it. We'll see. I don't like being called the genius just because I gambled. I did a 4-month gamble. I was looking to hold on to it a lot longer, but market conditions changed and Tesla didn't really prove anything. And my initial, again, I made a plan. I thought it was going to drop more and instead it went up and there was no reason for it to go up. And I wasn't willing to hold it when it went up. It's not too complicated. I really appreciate you sharing your knowledge and thoughts, man. I appreciate you, watching my videos, and hopefully you're learning something that you can apply to your own life. Not as financial advice. Don't sue me, bro. What happens to dividends if you hold CDRs and RSPs? Are they still taxed? Yeah, they're taxed, but they might be automatically done through the stock. It's like holding VFV, for example. So let's say you're Canadian, but you don't want to transfer currency, and you don't have to. You don't have to do shit as complicated as I'm doing it. I like I said, I'm anal. I'm maniacal about it. I've been doing it for decades, so you don't have to be as stupid as I am about it. You can just be a simple, oriented investor like my wife, and you don't need to think so like insane about it. So you can just buy something like VFV, for example, which doesn't really represent a CDR, but VFV is just the S&P 500, but automatically converted. So CDRs are just converting the currency for you. So I believe for the most part, so you can buy Teslas as a CDR in Canada, and a lot of that stuff. So I'm sure if you're getting a dividend, it might already have the withholding tax done. Because I mean, VFE, as far as I can tell, I think it's automatically done within the stock. So you're seeing the currency conversion in real time. I could be wrong. So if the Canadian dollar rallies, you're going to get less performance out of this. I just like I said, controlling when I sell or move my US dollars. Buffett always says, invest in America, VOO and chill. Yeah, it's a simple strategy. It's very simple. To some extent, I don't think it's a hard debate. I don't think VOO is enough diversity, in my opinion, because I mean, for example, I think you don't want, like, it depends on how long your time horizon is, right? Because over a 20-year period, you've never lost money in VOO, but we don't know what tomorrow, the future holds. And I hate saying that VOO is the best investment for everybody, because, and this chart doesn't go back far enough. Actually, let's look at SPY. Same ETF, right? Basically, but has a longer chart. My big fear is that you get stuck in a market like the dot-com bubble. Now, I don't think we're in the dot-com bubble. I really don't. The S&P 500 is a huge position in our portfolio, but you got to recognize that there was a very long period of time, from almost 13 years, where you got no return. Like, you could have cost average and you would have went up, and then you would have went down, you would have went back up, you would have went back down. You had to collect some dividends along the way, but your rate of return was garbage over a 13-year period, right? And we could go back to that with one black swan event. Like, you know, you never know what happens tomorrow. A tactical nuke gets dropped in the Ukraine. Who knows? Like, anything could happen tomorrow, right? So I like the diversity of income, right? Like, I believe real estate is really stable. Utilities like SCHD and some of these more defensive oriented plays, right? So that way I can collect extra dividends. So if the market does drop dramatically or goes into a flat line period, I'm still able to invest. Now, that's kind of dumb, because I do believe that we are in a technological revolution and that stocks are going to see margin expansion. Yeah, there's going to be volatility, but over long periods of time, these stocks should perform much better than they have in the past, which is what we've seen for the last 15 years, because tech stocks really didn't get to shine basically up to the last decade. And now they're the rate of innovation is just compounding at an insane rate, right? I mean, chips weren't even good enough to do like this AI stuff up till even recently, for the most part. Like, I mean, the evolution in chips alone, is excelling the market a lot. So you have to take all that into consideration, right? So yeah, like I said, that's why we own a bunch of individual stocks. We own, these ETFs, and we have a broad, diverse portfolio that provides income and growth. Because sometimes like I said, it's just me personally. You don't have to think that way, but I also don't have $1 billion like Warren Buffett, where a 1.5% dividend yield is enough to suffice me, right? I think that's how Warren Buffett thinks, right? He's like, oh, my wife can just hold that VOO or SPY because we'll have like billions of dollars worth of it, so she'll always have enough income. And I'm like, for every $1 million you have a VOO, you're barely making 10, 15,000 bucks. I mean, like, you got to have millions and millions of dollars to justify income off the dividend from the SPY, baby. 71 is the age where you can no longer contribute to an RSP. At that age, you have to start withdrawing. Okay, so I'll have to look it up. I don't know if things changed or what the deal is here. And I think the government was even talking about getting rid of some of the, I don't want to get into the topics of what the government's doing, because we don't know what they're doing until they do it. But you might be right. I just know at some point you do have to withdraw the vast majority of it, and it's sometime toward that retirement. SCHD, QQQ, VO is all you need. Yes, those three are actually very good stocks. You're kind of getting a lot of growth in there, if that suits your vibe. Is investing in cash is safe? I'm presuming you're talking about the cash ETF. Isn't investing in cash is safe? Yeah, so I utilize the cash ETFs, and another one, I think it's called PSA, is the Purpose High Interest Savings Account ETF for my parents. And I think recently we sold, or not public storage, Purpose High Yield Savings ETF. Yeah, this one right here. So these are perfectly safe. They're really awesome investments, because the only thing they don't offer is the insurance in case the banks go under, which I don't understand why they don't offer that insurance. So that's kind of risk. I'm not sure why, but I love these ETFs, because instead of me having to chase down deals on banks, they just go out and they get the highest yield they can on promotional rates. Because let's say you have $10 million, a bank's going to give you a better short-term interest rate on a savings account on a promotional period than they are if I'm Jimmy Joe Blow with $1,000. So I love these ETFs because they take advantage of that. You get a really great yield with no risk. They have absolutely no risk unless the bank goes under, I guess. So, I mean, they're as safe as safe can possibly be until interest rates go down. And then, yeah, you're just going to make less income. But the stocks don't change in value. It's just basically a holding account for high interest savings. You mean an ETF called cash? Yes. So, yeah, that's what we're talking about. So that makes sense. What's your thoughts on the move? So we'll get back to this and we'll talk about this real briefly. I haven't looked into it. TRP stock. I know a lot of people are talking about like Pembina pipeline. I'm gonna have to take a look at this and maybe do a deeper dive. You could tell me what's going on because you probably know better than I would right now, and I don't want to do a deep dive on this live stream. I'll maybe do some separate videos talking about pipelines because Pembina is doing exceptionally well this year. For dummies like me, who should I reach out to to help me build my TFSA portfolio? If you are not, so Dave Ramsey offers, I think, some really good advice on this because he doesn't even want you buying ETFs or mutual funds unless you have the fortitude to keep buying it and not sell it. Because typically what happens is the market goes down and people get scared and then they sell out. It's a psychological risk. So if you have the psychological fortitude to be buying stocks and ETFs in your TFSA and know what you're doing with confidence and having a plan, and you're going to stick to that plan no matter what the market conditions are, then I don't really think you need a financial advisor as much. But if you're not confident in that, go to a financial advisor. Because like my family, when they don't really know what they're doing, I recommend God, what's the company called? Why am I blanking on it? Oh man, I wish I could help you because they're a really great company. This hurts so bad. I'm having a brain fart over it. Let me think on it and hopefully I'll figure it out by the end of the video. It hurts me so much because they're really great financial advisors. And even my fiance's parents, we have, I think for some of my fiance's RRSP, she has it managed by a company. I mean, even some of our money is personally managed. We're not even managing all of our money. We do have somebody else managing some of it. And her parents have, managers and stuff like that. Like, there's nothing wrong with that. It's much easier for most people. So just, figure it out for yourself. If you think you need help, then, start calling people, but just make sure they're the right people. Cause I've seen a lot of bad managers. I've seen like my uncle, when I recommended the new people, like they had Microsoft and the people that own Microsoft for them was trading it. They bought it like 3 times and then ended up selling it. I was like, what the fuck are they doing? Like, why didn't you just hold Microsoft? You would have way higher returns. Reminds me again of you aren't using Norbit Gamma. I'm not, but you guys can Google that. Wealthsimple is 1.5% conversion fees until you have 100K. That's what I don't like. 1.5% is annoying. Wealthsimple has caveats to it. It's a good account for most people, I think, but I like my banks. I'm fine with them. And again, you have to keep in mind too, I noticed, and I made a joke about it, Brandon Beavis went all into Wealthsimple, and I don't think that's a good idea either. I take into consideration what happened with like CrowdStrike. And the reason we use like so many banks is because CrowdStrike could happen and you could have no access to your bank account. I mean, that did happen to one of the, I think that happened to Schwab, didn't it? I think if you use Schwab, you had no access to it during the CrowdStrike problem. So like I said, I like diversifying my money, multiple banks, multiple currencies. It kind of just removes that risk because there's always risk. And I just, like I said, you just want longevity and just protection. Then it's free. Quest Trade is a good platform. It's also a very great platform. 75% VFE, 25% HXQ. I'd have to take a look at these. I don't know what HXQ is. Dollar cost average, set it and forget it. TFSA, my 6th stream of income from retirement. Good job, man. Long-term investing in the S&P is a no-brainer. Over 30 years, it's never returned less than 8% since 1871. The NASDAQ is similar, but magnified 100%. Why is the long-term growth investing so frowned upon when it's just as cyclical as the S&P QQQ long-term? I can't see why not, if you can handle the ups and downs and the gains are huge. Again, like I said, it's risk tolerance related. I think it's kind of like a reminder of like TQQQ, for example, right? Like TQQQ has this risk because it's a triple leveraged ETF that if at any point in time, if the NASDAQ ever cratered by 33% in one day, you would lose all of your money. But this ETF has been around since 2010, and it has retained a 13,000% return. And even though like you look at these crazy mood swings, but there's problems, right? Because over the last 5 years, if you bought the top and you didn't cost average, I mean, you're still down 33% today. So, I mean, you got to cost average into these things, but I mean, can you handle that risk tolerance? And, are you sure that we'll never see a black swan event that'll crater the market by 33% in one day? You're young, man. I'm presuming most of us are young and haven't experienced, catastrophes in the market, but they do come. And you have to understand everything is hunky-dory until it's not. And then high growth income. Go back to 2021 even, right? Like look at small caps from 2021, devastated. A vast majority of small caps are wiped out right now. Most of them are delisted and you don't even know they exist anymore. So with the Qs, right, like I don't think there's as much risk for sure, and you can cost average into them. I just, like I said, for me personally, I like more diversity in income because you don't get income. And if something really, catastrophic happens and we see a really bad recession or even a depression, which is never off the table at any point in history, like something could happen at any point in time that causes that. I mean, you'd really start not enjoying growth. But I think growth should be a proponent of a portfolio. I still believe, this is why I'm not like a dividend oriented investor. I really think it's not a one thing fits an entire strategy. It's like Dave Ramsey says, right? Like he has a 4 fund strategy, like growth and income, aggressive growth, and I don't even remember what the fourth one is. But I think that matters a lot. Cameco is dirt cheap. Buy long, thanks. Thank me in 15 years. Cameco is an energy company, isn't it? Cameco, or is it a commodity play? I can't really remember. Cameco Corporation, the world's largest traded uranium company. Oh yes, the uranium plays. We talked about this like a week ago. What's uranium trading at, anyways? Uranium price chart. It's probably still holding up. Yeah, uranium is a good play for sure. If you're into commodities, it's probably one of the best plays because lithium is absolutely cratered. But yeah, it's still holding up. It's doing all right. For sure. How much money should you have in the S&P before adding something like VDY? It's personal, man. That's such a personal question. I honestly don't know. I only buy VDY because I like having a bit of Canadian stocks. And as you've seen in the portfolio here, like between me and the fiance, like Canadian stocks don't make up much more than maybe 12, 13% of our entire portfolio, maybe close, like somewhere between maybe 13, 15 at max. Because I like US stocks more, but I recognize that they're high growth, they're high income oriented stocks. They tend to grow their dividends nicely. It's good to have some exposure to living in Canada, but it's a very small exposure. Which do you think is going to perform best over the next couple of years, XLU or SCHD? It depends on what's going to be more interest rate sensitive. So let me just take a look because I actually don't know what XLU is or haven't looked at it that much at least. So let's just pull it up real quick and I can share my screen and we'll do a couple more questions here. Utility sector. So there's actually bonds or GICs you can buy that are actually backed by this ETF. I think XLU and maybe some of the Canadian utility stocks. And utilities are absolutely incredible because they have low volatility, right? And they do offer pretty nominalized returns. These ETFs are actually really great. Let's actually see what the holdings are in this real quick. I actually love this ETF. I don't own it personally, but I do love it a lot. It's actually something I've considered over the years to buy, and I just never bought it. You get Nexera, Southern Company, an incredible utility. Duke Energy, like these top three stocks, I mean, are like so profoundly incredible. Constellation Energy, these are all great. You could easily buy this if you want diversity. Like I said, I lack utilities and real estate in my portfolio, so I've been looking at some individual utilities. This could be a really good idea as well. To say what one will outperform and underperform, I don't know. Honestly, I think utilities are more interest rate sensitive than a lot of the stocks that might be sitting in SCHD. So if in the short term, I think if interest rates get cut quick enough, this ETF could definitely outperform because, even in the interest rate cycle, like it's been a very stable ETF. I mean, what's the returns on this even year to date right now? I mean, it's up 14%, right? Like it's crushing it. Actually, you're kind of getting me giddy that I should be adding this. Maybe I might buy a little bit of this. You kind of got me, you got my brain being tickled again because I really like V and Q and I really like this ETF a lot as well. And it might be better than buying like Hydro One or some of these individual these individual stocks. That's fascinating, actually. Thanks for recommending that. I'd bulk my investments in target date funds with employed manager by BlackRock. Yeah, that's actually really great. And it's on pace to exceed $1 million by 2035, but that's 45 years consistently. Good for you, man. Yeah. You deserve an applaud for that. Congrats, brother. That's the way it's done. That's a simple way to do it. Good job. For Canadian RRSP account, do you need US RRSP account to buy US? No. So for my parents, I'll give you a quick example. My parents don't have a US account, and I buy US stocks directly. And what'll happen is it'll just automatically convert the currency, but any dividends you receive will automatically be converted to Canadian dollars. And anytime you sell the position, it will also be automatically converted back to CAD dollars. You have to request a US account. So when you open up an RRSP or TFSA, you specifically have to tell them, I also want a direct US currency account within the TFSA. So if I show you the account right now, for example, like in my TFSA as an example here, you can see that it says, I have these two accounts, right? So you can see that the top, which I wish it would show a little better here. Let me remove the question here. So you can see it says US account positions, and that above it would say Canadian account positions. So they're actually two separate accounts under the TFSA. But you just request it. It's super easy if you want to do that. And then you can convert the currency yourself, collect US dollars, and invest US dollars without dealing with constant conversion. For money, what else we got here? TC Energy, they are selling $1 billion stake in their pipeline system to First Nation communities. Good or different move. The price of the stock currently, well, it depends what they're going to use that capital for. If they're paying down debt or using it for further investments, it really depends on where that money's going when they're raising $1 billion, which is why I like Enbridge, because like they're raising capital and they're utilizing it for very big purchases to solidify their business. I don't mind people selling parts of their business. It just depends on what for. Like if it's to pay down debt, I'm usually not a big fan of debt payments. It just I don't know. It's great to pay down debt if you have the right position to do so. But if you have to sell your assets to pay down debt, it's usually not meaning you're not in the best position. Yeah, I was thinking 3 or 4 ETFs to keep investing into without pulling out when the market drops. Hold around 20 years. Yeah, I mean, if you can do that, man, you're set. You just got to get a strategy and stick with it. Just don't listen to YouTubers, because right now everyone's buy Palantir, buy Tesla. If a YouTuber's recommending it, avoid it like the plague. Yes, it's done well, but go back 3 years ago and look at all the stocks people were recommending. I mean, they were recommending Palantir at the top of the market before it crashed. And now it's only just getting back to where it was when it IPO. You just got to be real careful. Usually when everybody and their grandmother's talking about it, you're doing something wrong. And I've learned that over a decade. I've seen a lot of stocks come and go, everything from the MJ boom, the crypto boom. A lot of those small cap cryptos haven't recovered like Bitcoin has. There's so much risk when people are pumping and hyping stocks. It usually means overvalued, right? So you got to be a bit careful. You don't want to follow what everyone's doing. It's just like Meet Kevin. Use Meet Kevin as an indicator. When Meet Kevin says he's selling his portfolio because he's scared of a recession, probably a good time to buy, or at least keep cost averaging. Don't stop buying. Do you buy CAD hedged versions of American stocks? No, I don't care about CAD hedged. I don't think there's a reason for it, to be fair, if you're already owning the US dollar. I think if something catastrophic happens, dividends will be the first thing to be sacrificed. Not really. In most crashes, the dividends will not. It depends on the cyclicality of the crash. Certain crashes, like the real estate bust of 2008, if you owned only REITs, yes, you probably would have saw some dividend cuts. A lot of sacrificing, sure. But in a diversified portfolio, telecoms didn't get destroyed in the 2008 financial crisis, but the stocks went down. They kept paying their dividends. There's a lot of companies. Actually, the Canadian banks have paid their dividends through the 1990s interest rate cycle, the 2008. I mean, the Canadian banks have never cut their dividends and have paid through every recession and market crash. So, I mean, if you have a diversity of income, not every sector is going to be hit the same. So, I mean, it's just something to take into consideration. I don't think dividends will be sacrificed in all crashes, but tech stocks will crash. Growth stocks will crash in a crash. They tend to drop pretty dramatically, and you don't have income to support any of it because it's the psychological effect of, oh my God, sell it, even though it might be Google or Apple and they didn't really change their business at all. They just crash, and then it's a buying opportunity. And then I have dividends to buy more of the stock. They were recommending Twilio, lol. I mean, everybody was recommending, marijuana stocks in the marijuana boom, and that didn't work out very well, right? I mean, just be careful with YouTube and social media. I've got good relationships with Edward Jones. Thank you. That is who I was trying to figure out. I know some guys at Edwards Jones, and they are chef's kiss for the most part. Maybe there's some bad investment advisors in there, but the guys that I know that work for Edward Jones are incredible. So yeah, they charge fees, but their customer service is excellent. I've heard nothing but good about these guys. Again, I'm not recommending them as financial advice, but I did recommend them for my uncle and aunt, and they have been exceedingly happy with them after getting a really bad investment advisor or investment manager. And yeah, you're going to pay a fee, but that fee, again, long will exceed the value if they're doing a great job, and you don't have to deal with the psychological stress because you might not be a person that can handle that. I'm still buying VDY, of course. I'm always buying VDY. Awesome. Yes. So I appreciate all of you stopping in. It's been a pleasure as always. Until next Sunday, stay cool, stay awesome, and I'll catch you.